Okay, welcome back. Hari Shyamsunder is with us. He's with Vice President, Institutional Portfolio Manager at Franklin Templeton. Hari, good to have you with us here as always. Thanks for your time. Just some feedback about what are you hearing in the market? I think everyone is asking everyone else what's happening. But that's the kind of market we are in. So let me ask you, what have you picked up? What's been happening at Franklin? And just some feedback.
So good afternoon. It's great to speak with you again. Firstly, we welcome the greater focus and the entire debate about mid and small cap valuations. Undoubtedly, in the last 12 months, we had seen signs of complacency setting in really in this small and mid cap space. And I've had interactions with newer investors who seem convinced that, well, all you needed to do was invest only in small and mid caps, irrespective of risk tolerance and investment goals and your time horizons. So the volatility which we are seeing in this space is the price of investing in small and mid caps. And we've seen this in previous cycles as well. I mean, the implications of this for investor goals needs to be better understood, particularly for newer investors. And I think the need for diversification should be better appreciated as a result of this. So going forward, this is not going to be an easy stock picking environment, particularly in the small and mid cap space. The last 3 years gave that impression that it's going to be easy and anything that picked up would go up. But this, I think, changes over the medium term. And this is what investors need to better appreciate going forward. The conversation which I've had,
No, go ahead.
Go ahead. Yeah, the conversation which I've had, I think there is a lot more questions being asked about what should one do about this? What should one do with small and mid caps in this particular environment? What's unique about the small cap cycle which we're going through, and how should one look at it going ahead?
And what's the answer to that, Hari? Because some of the froth has been corrected. The mid and the small cap indices are down 20% from their recent peaks. Individual stocks are down 30, 40. So at this point of time, what kind of funds should one be allocating to? Should it be sectoral funds like banking? Should it just be a pure play nifty ETF kind? Should one be looking at mid and small cap, considering that some correction has already taken place? How would you allocate money now?
Now, I think I'll first point or make a point here that, globally at least, there has been no small cap cycle. If you look at developed markets or emerging markets as a whole, small caps have actually underperformed large caps over the last 10 years. I'll say it again, small caps have underperformed large caps in many other markets over the last 10 years. So there is no global rule that small caps should outperform. India has been unique. And what is common to the small and mid cap universe is globally is that these tend to be more populated with industrials, financials, and consumers discretionaries across the board. This is what small caps and mid caps tend to be. These are linked to the economic cycle, and that is what has driven the broad-based broad-based growth in India. So we continue to believe that India is on a multi-year capex cycle, and such periods definitely tend to lead to better earnings growth for small and mid caps. But while the earnings growth for small and mid caps may be better than large caps, the starting point is going to be a handicap for the space. So even if earnings growth here exceeds that of large caps, their outperformance over large caps that we have seen in recent times might not be repeated. We're continuing to recommend investments to diversified equities and hybrids. We have noted that our dynamic asset allocation hybrid strategy has actually been increasing allocation to equities in the last 6 months.
So how should one play this multi-year capex cycle? If the starting point for investing in industrials now is going to put you in a handicap, it's very high right now. So what's the best way to play it?
So it gets back to the earnings and the valuation which each of these spaces are pointing out to. If you look at the large cap space over the last 5 years, 5 years ago, if you look at it, it's almost exactly 5 years since we were hit by COVID and all the pain and disruptions which accompanied it. So that's a good time horizon to look at earnings growth and price movements, since the starting point, if you remember, was not particularly a raging bull market. Sentiments at that point were pretty subdued, with the mid and small cap going through a bit of a slowdown in the previous 2 years. So, with that in mind, if you look at the large cap space, the earnings growth since then has actually outpaced the index movement. So earnings have grown faster than what the price movement has been. So the large cap space has actually derated in this over the last 5 years. For mid and small caps, of course, the earnings have done better than large caps, but the indices have done a lot better. So within these, I think it gets down to a lot of stock selection. We are not throwing out the entire small and mid cap space completely, and that's why we are recommending diversified equities even at this stage. If you look at some of the sectors where we are positive, we continue to be positive on, broadly positive on banks, consumer services, healthcare. There's some other spaces which our funds are broadly overweight on.
Got that. By the way, Hari, any way to think about what happens to capital market plays, AMCs, and I was looking at something like Nippon India, for example, looking very attractive now, purely on a PE basis and where it's come off from. But of course, all of that depends on. And I'm just talking to you on a day when we had the mutual fund numbers for the month of January, still very strong, still looking pretty good so far.
Absolutely.
So anything you like in this space, CAM, CDSL, or whatever? Go on.
Yeah, I can't get into specific names, but we have been playing it through some of the broader market plays, broader capital market plays, rather than specific, MC plays, for example. So of course, this is a theme which is going to, Indian markets are still developing in many ways, and we are positive on the long-term outlook of the capital market plays. We have been playing them through some of the broader names. That's what I will speak about.
Chemical companies, any contra bets? For instance, where you anticipate an improvement in fundamentals, they're close to bottoming out, and therefore it's a good recovery play?
Yeah, some of those names are looking a bit better on the chemicals and agrochemical spaces. So we have seen some of the numbers at least looking better than what were expected, and we have certain positions in some of these names which are being particularly beaten down. I think again it gets back to where the valuations have become a lot more comfortable. And which are pricing in pretty low expectations, and some of them are starting to look pretty attractive.
Okay, Hari, until our next conversation, thank you for joining us, and good luck as you navigate these markets at Franklin. Well, we're going to take a very quick commercial break here. We're going to come back with more. But Pankaj Tibrewal of Ikigai Asset Managers, erstwhile with Kotak, believes that he's more bullish. I mean, straight up, not buy everything now kind of bullish, but he does believe that the market is ignoring some of the positives which are already starting to emerge. He also said that his interactions at conferences with